we still have foreign investors piling in to take advantage as local investors pile out. To what extent are local institutional investors latching on to some of the opportunity, though? Because one would assume that we'd have to draw some distinction between the local retail market and the local institutional market.
I think with the local institutional market, on the macro factors, I think the broader picture is, really concerns about the inflationary environment, concerns about expected lower GDP growth for this year as a result of various factors, including political factors, weather conditions. And so I would say that a lot of the institutional investors would be adopting a wait-and-see approach as opposed to the foreign institutional investors who are really taking advantage of the weakening of the shilling to buy stocks which are at a much cheaper level. And I think on the retail investor side, a lot of them are actually quite quiet. We actually haven't seen a significant surge in retail investment activity since the aftermath of the crisis in 2008.
Well, that despite the fact that we're seeing a lot of bright beacons emerge over in Kenya presenting opportunity. We've started to see some of the mid-tier banks report. We touched on Diamond Trust Bank a little earlier this week. This morning, NIC Bank reporting a 52% increase in profits before tax. What's your view on that company? Have you had a chance to look at those numbers that have filtered through this morning?
I think the numbers are actually quite impressive and really a reflection. One, I think what is actually comes out quite clearly is that there was a contribution of about 10% to the revenue growth from the subsidiaries. And NIC has actually quite embarked on a fairly aggressive expansion, both in terms of the branch network and also opening subsidiaries like in Tanzania, and also consolidating its presence in terms of offering investment products like in the investment banking and stockbroking. So that's actually quite significant and a reflection of a fairly aggressive expansion program, but also the fact that it's also enhanced its cost-to-income ratio, which is at about 40%, which is actually one of the best that we've seen in the market, in the banking sector.
Of course, with that expansion and growth, that cost-to-income ratio is just one of the figures that stand out. The other is that we've had provisions for bad debts reduced by 82%, and on the surface, that certainly seems pretty impressive.
Yes, it's quite impressive. Again, I think it's also a reflection of a very careful risk assessment on in terms of looking at the clientele and also collection, in terms of debt collection. It's a fairly, it's a bank that has over the years reflected a very careful risk management program, and I think the results clearly reflect that perspective.
Well, we'll certainly be monitoring that share price movement as we progress through today's trading session. In the meantime, as I mentioned earlier, KenGen's shares are moving higher to 15 shilling 75 yesterday and hitting a 12-week high. Why are the elevated expectations around this company's full-year earnings numbers, which are anticipated next week?
I think with regard to KenGen, we've seen one of the, in terms of an improvement in terms of some of the projects that the company has been embarking on in terms of diversifying its power generation sources. The company engaged a few years ago in a debt raising issue in the infrastructure bond, and has been fairly aggressive in terms of looking at alternative energy sources. And I think that is a reflection of the high expectations are really a reflection of some of those projects' results, although they are long term. The outlook is fairly positive that over time it will be able to effectively address a lot of the energy deficiencies that we're seeing in our market, particularly on the geothermal energy and other alternative energy sources.
Well, talking about those players within the energy segment, we had oil marketer Total Kenya releasing Q1 numbers yesterday, posting a 12% drop in first quarter pre-tax profit, and of course being hit by the fuel controls that we've seen being imposed in the country. Your overall impressions of that company and the numbers that were released?
I think you've already mentioned it quite clearly. One of the key factors that has come over in this particular year is really the aspect of price controls. And one of the reasons why Total's profits were down is because as they announced in their press release, they were not able to pass on entirely the additional price increase in crude oil prices, and therefore they had to bear some of that cost. The other aspect also is that the inefficiencies in the energy industry have also played a part in the fact that there have been quite some delays in terms of delivery of products. And I think that also culminated in what we saw last week in Kenya in terms of a fuel crisis.
Yeah.
So I think the results of Total really reflect the state of the energy and oil industry in Kenya.
When it comes to those inefficiencies, we had the government on Monday say that it plans to upgrade the country's sole refiner. Have any timeframes been given for that upgrade process? And what's the approach from Total but other oil marketers in the country as well? Or are they pretty much forced to sit on their hands and wait?
I think the issue of upgrading of the oil refinery is something that has been on the cards for a very, very long time. And one of the factors, a lot of the investors, the initial investors in the oil refinery, eventually sold out their shareholding to the government and brought in a new player into the market. So the shareholding in the refinery, essentially the government and one other key player in the oil industry. And I think because of the amount of capital that will be required for the upgrade, there hasn't actually been a timeline and that has been adhered to. So even now, despite the fact that the government acknowledges that there is need to upgrade the refinery, there actually hasn't been a timeline that has been put in place to give a guide as to when that is actually going to happen. So it doesn't look like we have something we can actually say is really going to happen. So I think alternative mechanisms have to be sought into how to address those supply constraints that are the result of the inefficiencies in the refinery.
So very quickly, Einstein, with so many exogenous factors at play and affecting Total Kenya specifically, would you be a buyer at this stage?
I think the challenge is particularly the price controls. I think that is one factor that really would be a constraint to an investor who would be looking at investing in the oil industry entirely. So I think that will be one key challenge, because when we have controls, it means that there are obstacles in terms of realizing the full capacity and potential of the business.